viewers out there today, what me and Mike are going to be discussing is how COVID-19 has affected both of our industries. You may know that I'm a real estate agent. So my side deals with more of the consumer. We want to buy the house. We're getting the perfect deal. But with Mike is more of the financial side. Like he said, he's the one actually funding these loans for these people. So first, we have 3 questions that me and Mike are going to go over. Our first is refinancing. Well, Mike, what I want to ask you is, 1, what is refinancing for the people who may not know? And how can refinancing help people, consumers in this time?
Absolutely. So refinancing, what it is basically is just kind of taking a look at, where your loan's at now. It's basically redoing a pre-existing loan. And as everybody knows, well, maybe not everybody, like you said, as the industry and the economical standpoint of the U.S. that moves forward, everything changes, right? So you look 20 years ago, mortgages were at 18%.
Yeah.
Now they're way lower. So you have this amount of time that you have your mortgage for 30 years. There's a lot of changes in 30 years that can happen. You're giving a second opportunity to try to get a better rate for yourself, to try to lower that payment, to get rid of, the first time buyer situations that banks put out there, that people put out, there's a refinance is basically just reestablishing the debt you have to make it more affordable for the individuals.
Right? Okay, got you. So in the sense with COVID, a lot of people have these mortgages that a lot of people may have got furloughed, may have got laid off. So in a sense, is what you're saying is if I refinance my mortgage, my payments would go lower in a sense, right?
Typically, yeah. I mean, unless you're looking to do, cash out and stuff like that. But obviously, those are all different programs. But yeah, more than likely, if you're looking to refinance and you haven't done it within the last 2 years or so, more than likely, you're going to get a better deal. Rates do fluctuate. They go up and down. So, I mean, staying intact with the market, speaking with your broker, speaking to the people who know in the industry what's really going on, people that you trust, they're going to tell you what's going on, because I think it was 2018, or was it 2019? 2018, we had a huge spike, right? 2018, technically it was a year and a half ago, they were back up at 5%. And right now, a year and a half later, even in the pandemic, right, a lot of people can be qualified for around 3% or under.
3% and under, yep. Because that's the rate I'm typically seeing is between the 2 to 4. And with my time being in real estate, the highest loan I've ever seen really was about 8%. And that was somebody with the credit score problem, and that has a bit of a complication and within the percentage you're going to get with your loan. So if the credit score isn't intact, then the higher percentage of the loan is going to be. So I appreciate you explaining that. So my second question is, how has COVID-19 directly impacted you in the lending sphere of real estate?
Directly impacted me. So I had been working on a few deals that were, ready to go within the next week or two, ready to close. We had all the paperwork in, appraisals were ordered. People were coming out within the next 2 weeks. I was looking, hopefully to close with the 4 or 5 deals. And then next thing I know, COVID happened, and I would never put anybody's name out there with this kind of information, but, some of them lost their jobs. Non-qualified mortgages went out the door. Their ceilings jumped up to 6%. And between those two things, a lot of unknown happened in the beginning, right? Nobody knew really what was going to happen. Everybody's freaking out. Guidelines are coming out, things are on halt. So it really made it difficult to be able to want to push forward, to want to continue talking to people and be like, hey, we're going to get you a really good deal. Being a broker, we do have the opportunity to get the best deals in the industry.
Because you're on, again, for a lot of people don't know, you could be a broker and be on the loan and financial side of everything. So you're not just a broker. You're not just limited to what he was saying earlier. You're not just a real estate broker. You could be a loan broker, and it's 2 different sides of the transaction. loan,
Absolutely.
I would say a real estate agent, we know a bit more about the market in a sense, and to where the home's prices. But where you come in handy is learning the best price of the loan, you know, and really
Correct.
giving people, because I would say in a situation that when it comes to getting the loan, it's a bit more tricky and a lot more pressure, because you want to know when you're getting that, you're getting the best loan for yourself, you know, not even getting the best deal, because once you get the best deal, you can get $100,000 off the house that you're asking, but that 100,000 still is going to be going towards that loan. So you want to make sure that like you said, you're trusting the loan broker you're working with, and making sure they're not just trying to make a commission, but trying to make sure they're putting you in the best position. So I like what you said about that.
Correct. And, you know, contrary to popular belief, not always is the lowest interest rate going to be in the individual borrower's favor. That's a big factor of where we kind of come into play with being able to execute this kind of stuff. So, you know, you could, and, you know, people run into this all the time. I especially, you know, people say, hey, I want the lowest rate. I said, absolutely. You know, we'll look at the lowest rate we can qualify you for, you know, and when you go over that with them, what the interest rates are at and how, you know, because they hear about other people getting 2.5s or 2.8s or, you know, and 2.8 is definitely reasonable. It's happening. A 2.5 has happened. But for some people that do qualify for it, but it won't be the best for them, is those people that have to pay out of their pocket in order to get that rate. Now, I understand how everybody looks at it. You know, well, I got to pay this money back. You know, I owe it, you know, 2.5% or 3% instead of 2.5. Like, I get it. But the way you're financially set up right now, like, we'll get you set up at like a, you know, let's say it could be a 3 instead of a 2.5. And, you know, the credits will go towards the payments at the end.
Exactly.
So, you know, people say, you know, give me the best rate. I want the best deal. Well, we're going to work out the best deal for you. I promise you, you know, with your financial situation, we're going to make it work for you, because legally we have to, otherwise it won't work. If there's no benefit for somebody, loan won't go through.
Exactly. And like you said, not the best percentage doesn't mean you're getting the best deal. A low percentage may not mean that the loan is for you technically. And then I have another question besides the one I was going to ask you. A lot of people think going to bigger mortgage industries, such as big banks, in a sense, like Chase, Wells Fargo, Bank of America, they think since they're already banking with these industries, that their first option is to go get a loan from them. What would you say about these bigger corporations? And would you say that these corporations have the best intent for their consumers when they're getting the loan? Or would you say that you should explore all your options when qualifying for a loan and not just speak to one person directly?
Got you. So I love this question. I do. You know, and so many people answer it differently. I see people going to banks because they bank with them, right? They feel comfortable. They've been banking with them for X amount of years. You know, I'm not going to go talk to a stranger about money. Let me talk to my bank who already situates it. They have all my finances. I don't need to do anything. I get it. I really do. You know, and banks are in the business of money, right? I will never knock anybody else's profession as far as what they do. I think, you know, banks, they do have some great programs for some people that need it. Are there differences between a brokerage and a bank? Absolutely. We, as brokerages, I mean, we have a lot of qualifications we have to follow. We have a lot of things we have to do. Banks do as well. They might have more. They might have more qualifications. They might not have the best rates because, let's face it, like we said, banks are in the business of money, right? They save our money. They take our money. They do whatever with it. I don't believe that they have the best rates, but I don't think that they would lead somebody in a negative way. You know, I really don't, especially now. I mean, since 2008, everything's super highly regulated.
Exactly.
You know, it's pretty much, it's really hard to try to even mess somebody up through a loan. You know,
and that's what a lot of
because
people don't get. You know, a lot of people refer back to 2008 and exactly with this, a lot of people refer to 2008 and think the market's going to crash in COVID-19. But what I try to explain is that with 2008, that was based on people paying fake money in a sense, you know, that they were getting loans. Like, say you would give me a loan, I'm 21 years old, I could qualify for 300, 400K without you even seeing my bank statements, or people were, in a sense, were making fraudulent bank statements, making fake W-2s. So at the end, I still got the house that I wanted, but 2 years down the line, I couldn't make those payments anymore. And especially with a subprime loan, when those interest rates in 2 years, they skyrocket up. So now your mortgage payment in 2 years is different than when it was 2 years ago. And now when you add this up to people around in the US, just add them up in every state, that's how the market crashed, you know, not in the sense where a sickness or a disease is coming into each market. Yes, it messed the economy up, because in the economy, that's where people are spending money daily in the transactions, you know, and in stocks where people are exchanging stocks and everything. But if we take a step back, everybody's getting sick. Everybody's getting sick. Now we're not making daily transactions to where now the market is severely taking a crash. But within the mortgage and the real estate industry, it's everybody was still paying their mortgage, and their mortgages weren't fraudulent. They weren't bad work. So it's not going to impact it. It's only impacting the people who are trying to sell at a higher price, because not everybody coming in wants to buy at that high price, you know? So a lot of people think that's what coming in. I really learned about that. I learned about 2008. I made sure I studied it, because a lot of people refer back to it, and it's not always, you know, it's not 2008. It could happen again. I'm not saying it can't, but the work that they're doing now, and the money that the real estate market and the finance market is built around, is actually sustainable. You know, it's actually real money. You know, it's actually people who are coming to buy these either $1.8 million home, $2 million homes. They actually have the money to verify it, and you know, loan brokerages like you, they're making sure that they have it, and not. You know, they're not working with, okay, you don't have, we're going to steer you out of this direction because you don't have the money to make the payments. We could qualify you for it, but is it going to be worth it for you at the end of the day, you know?
Correct.
So I appreciate
it always
you going
has
in
to
that
be.
direction. Exactly.
Yeah, and that's where the industry is going, and you know, that's why they did all the work they did after 2008, because I did as well. I studied it. You know, I wanted to make sure that I knew what I was getting into, you know?
Exactly.
Because
you'll get questioned regardless. Wherever you go, you're going to get questioned when you're in this industry about 2008, especially on your side, because that's where the subprime loans really came, was from the loaning side. You know, when the loan business, the real estate agent is more just showing you the house. And then I felt back then, a lot of real estate agents didn't want to get into that side of it, because they knew what was going on already, you know? So if they just guide you to the loan officer, then it's from their point, I had nothing to do with you. You know, you can't really blame me for putting you in the position to sign the subprime loan, because I just put you in the direction. I didn't really make you sign the contract, in a sense, you know?
Correct. So not only that, I don't think we've ever seen regulations come out so quickly after a pandemic hit.
Exactly.
You know, it was probably, you know, within the next 2-3 days, they had all new guidelines. You hear about FHA's new guidelines, conventionals, who can qualify for what. I mean, they raised, you know, the credit score qualifications for FHA at one point.
And that's where we're going to go with this next question. So I'm glad you're going in that direction. So before I stop you there, because you're already answering my question for me. So just how did the qualifications change within the loaning industry? You know, how did exactly what you were saying, FHA changed their guidelines came out, bam, I was showing a house to a couple. Within 2 hours later, we were talking about how, you know, the bank reserves were lowering their standards, and they're lowering their scores. So a lot more people could potentially come into this market. So again, just go on and go on how you were saying, how they changed their qualifications, and how the whole loan industry has changed from your perspective.
Yeah. So, I mean, and it seems that it's kind of plateauing now, but in the beginning, it was wild. It was like almost every day we were waking up to, you know, someone new announcing some new qualification. You know, and like I said, I had lost about 4 or 5 going into it. And, you know, it was all over the place. You know, I had one guy who was approved, ready to go. He hit a certain mark, you know, on this new qualification that came out on conventionals. He hit it was like a 75% LTV. He was at 45%, you know, debt to ratio income. And then he had one other thing, and they were like, he needs to have 6 months of reserves. All of a sudden, that came out as soon as COVID happened.
All of
we
a sudden,
were
that
ready
changes. We already had the background work done.
Mm-hmm.
But now, since the new qualification has came, it changes the whole dynamic of it, you know?
Mm-hmm.
And that's crazy. Keep going on.
The appraisal
That's
was
crazy.
ordered. He was going. And the next thing I know, I had to call him up and say, we can't do a loan anymore.
We can't fund this because the guidelines have changed, and it's we can't call them up and say, we've already had this beforehand. Can you still accept it? And they're like, qualifications have changed now, you know?
Right.
Wow.
And we looked at everything that was going out, you know, me and my owner, Anthony, you know, he's, I've been working with him and, the owner of the Bell Group. And we were both just sitting there looking at everything we could, try to find this, where's this? You know, how can we, you know, maneuver it so it could work out? And, you know, everything we looked at, nothing could work. So it was like, you know, we did everything we could, and we hate to tell somebody at the end of the day when we've done, especially when the clients have put all that work to get all the documents, you know, we're having them sign things, we're sending stuff back and forth, and to get to the home stretch to tell a client it's dead, that's horrible.
Yeah,
that's horrible for us. That's horrible for the client, and nobody wins at that moment, you know.
Yeah.
So it's been a flux of negative and positive, because I still have had a deal that's been able to work actually through COVID. It started before, okay, and it reopened in the middle of COVID. At one point, it's just, you know, 30-year refi on a income property.
Okay.
Right? And, you know, they're good. It's been smooth. We did the appraisal. You know, they came in at a really good rate that we were able to find, which is, as soon as I found it that day, I called them because I was checking, right? At one point, dude, they're getting at like a 375 on an income property. And at one point I was looking, and it cost them $20,000 when COVID hit.
Wow. 20,000.
3.75. $20,000. And,
wow.
you know, I kept on with me and my boss, and, you know, we're quoting it out every day. And one day it came back, it was getting better. And then one day it was like, hey, 375 with credit. I said, let's lock it in, because at that time, Quicken was the only one who was doing locks. So we were able to lock it too, because at one point, everybody stopped locks. You can lock alone. So it's like, hey, you know, this is where it's at today, but I can't really say that it's going to be this where it's at in 30 days, 45 days.
Exactly. Because that's how quick it changes for everybody out there. That's how quick anything can change within the loan side of everything. Your percentage can change in just 30 days, you know, and that's
even one day.
Yeah, exactly. And that's why we have the difference between the pre-qualification and the pre-approval. A pre-approval is what Mike would say, this is what you can get, you know, and that wouldn't change. The percentage may change, but what I'm approved at won't change. But your qualification is only really valid for 30 days too. So once that qualification is up, we have to do a new qualification for you too. So I appreciate you touching on that.
Absolutely. It's important, you know, for people to know that. You know, I've run into it a few times where, you know, I quoted somebody something, and this was before I was a broker. I quoted them something, and they were like, okay, perfect. And then a week later I get a call, and they said, hey, you know, just want to check in, see how everything's going. I said, well, you know, we were just getting a quote. Did you want to get that in? They were like, absolutely. I was like, oh, okay, perfect. You know, and then everything changed. A week later, rate jacked up. You know, it's like, okay, you know, some people think like, okay is like a let's get it started, but like there's so much pre-work to get something started, so you lock it in.
Exactly.
So I think that's one thing that you know, clients that I try to inform clients in the beginning is, hey, you know, during this process, I want you to understand that there's going to be a lot of documents that are going to be needed and signed. I just want to make sure we're aware of that. I want to work with you the entire time, you know, and just kind of let their expectations know about, especially now, and timelines too. The paperwork, the process, and timelines, man, those are super important for clients to know. You know, before COVID, we were, I think, operating 20-day closes, and And those are, new purchases too. And now we're running.
It's typically around 25 to 30 days when you're closing a home. So anybody out there, if you want to buy a home from start to finish, not from start to finish, because once you find the home that you want and you want to put an offer in and you get approved from it, then it takes 30, 25 days for actually you to get in the home because of all the pre-work, again, that we have to do on our sides of everything. So it will take you about 25 to 30 days to close the deal. So thank you for that again.
Absolutely. COVID, sometimes right now it's, a lot of people are talking 30, 35, sometimes 40, 45.
Mm-hmm.
So, I try to keep people within their expectations, and we always have ways, most of the time, at least we have some ways to extend locks and stuff like that. So, it's been a really interesting time to be in this industry. I can tell you that much.
It has.
Yeah, no, it's a great learning experience to be a part of. It's a great, is business slow? For me, a little bit. It is. I'm not gonna lie.
Mm-hmm.
But this experience is definitely one to grow from and to be able to see, what happens when everything does go south.
Exactly. And now we're in a position to where we've learned a lot from this specific situation. And now if this does occur again, we know A, how to prepare for it, B, how we can maneuver through it, and C, be more successful throughout it, because this one is, again, in real estate during this time I've learned a lot. I've had a couple deals go through, and I understand, I've seen perceptions change. A lot of people are saying they could get good deals during COVID, but the seller wants to sell at the price that they want it. But you have to take into consideration how long properties have been on the market. If they have dropped, you have to just be aware of everything. And being through COVID has helped a lot, just because I've seen, this time could either make you or break you. A lot of agents could either be making, I'm not saying I'm making the most right now, but I'm doing what I can to help myself out and help my career grow. Or you could just say, you could just give up in a time like this, to where, okay, this is the tough times there in real estate. Now I see it. I don't want to bother with real estate anymore, because I've seen the ups and downs. Everybody says ups and downs. This is a down period because we didn't expect this to happen at all. Nobody expected. We heard COVID. We've heard coronavirus, I would say, since February, but we didn't take it as serious. But now to see where we are, we can see how anything can impact any industry, because it's not just us that are taking a toll from it. It's everybody, it's small businesses, big businesses, having to lay people off. People are getting furloughed. People are actually, getting fired from situations like this. So, but to actually grow and learn from it, I feel that has helped both of us,
Absolutely. Absolutely. I think we brought it up not too long ago when we first met face to face. It was right before everything happened.
Right before. It was right before. It was that, it was crazy.
We were talking about it, feeling each other out, being like, hey man, how do you feel about this? Because nobody had any idea.
Exactly.
They were like coronavirus?
Yeah,
come on.
Exactly. Right before. And then I would say 2 weeks later, everything shut down, everything shut down. And the only way we are able to connect is through these Zoom meetings, and I'm glad that you had time today to give the consumer just more value and more education about this, because, I didn't know a lot about it growing up. I'm sure maybe you didn't. You had to learn this knowledge on your own. You had to acquire it yourself, and you had to go out and learn it yourself. So what we're doing is just trying to give out a bit more education through these hard times, and hopefully people will value it,